Amazon shares are slumping after a third quarter report that fell short of expectations. Weaker than expected guidance also issued by the company for the upcoming holiday season. Joining us now is Tuna Amobi, analyst at CFRA. Yeah, we said shares slipping 100 points. That'll get your attention. In the past, with Amazon, Tuna, if you had deferred to Jeff Bezos about what he's doing when he was spending money to build out Amazon, if you had just gone along with him all those times, it's paid off. Should he be deferred to again this time with spending the money to do this, to build out the one-day shipping for Prime?
I do, Joe, and I think, and for good reason for that matter, right? So the one-day delivery that we're seeing, I think the data points that we see kind of reassure us that it's actually the right step for the long term. Prime members are ordering more in terms of volumes as well as value of the order, and the long-term economics of the one-day delivery so far seem to have justified the ratcheted investments that we're seeing. So yes, the return to heavy investment cycle is something that we can live with.
It's kind of interesting because that is what they've seen. If you can get it the very next day, it's causing people to actually buy more and order more on that individual order, which is exactly what you want. But you got to get the inventory closer to people, obviously. You need more warehouses. You need more people delivering, right? 750,000 employees now.
That's right.
At Amazon.
And that's why we're seeing, shipping costs continue to escalate, right? This past quarter, I just spent $9 billion in shipping. This current Q4, they're guiding for one-day delivery alone to impact the results by $1.5 billion, which is double what we saw in the third quarter. So the trend line continues to increase. But as I said, I think this is something that over time, the return on investment will be quite justifiable.
And the cloud, AWS, is decelerating, but still an unbelievable business. Some people say that analysts are going to look for margins there to help with the margins that are being hurt by the expenses on shipping. Is that going to continue?
Well, the AWS has really, been a phenomenal, business. The secular trends there are very good. They just came off 35% growth rate for a business that has been, growing, phenomenally. Now,
it used to be 37 or 40%, but 35 is still amazing, right?
Sure, there's a slowdown there. It's now a $36 billion run rate business, and we think that Amazon Web Services right now is almost like, almost half of the value of the entire company. And remember, this is a unit that has built an ecosystem of machine learning and AI that tends to fly under the radar, but they're deploying all these new technologies phenomenally. And more importantly, I think we're seeing Amazon now, shifting to higher margin, revenues. I think that's a fundamental shift from the e-commerce to, areas like cloud and digital advertising, third-party sellers, all those things.
All right, so do you have ratings? What's your rating? Do you have a target?
Actually, we did reduce our target, last night, Joe, to 1950, and part of that is the investment cycle we just talked about. Okay. But nothing has changed on it.
It's a short-term, long-term story. It's exactly what it is right now, and it always has been with Amazon. And 100 points for Amazon, those are the short-term people that might want to, wait that long, but you would say long-term people hold.
That's right.
Okay, good.